Welcome to another Barometer Wednesday afternoon webcast. I'm Pamela Hastings, Relationship Manager here at Barometer Capital. Today, we will provide you with a brief market overview. And of course, at the end of our conversation, we will be pleased to address your questions. I've had a few come already through my email box. And of course, if you want to participate, send me an email, phastings@barometercapital.ca, or hit me up on the Zoom chat. With that, I turn the conversation over to David Burrows, our Chief Investment Strategist and President at Barometer Capital. Good afternoon, David.
Good afternoon, Pam, and good afternoon, everyone. Thanks so much for tuning in. Another week goes by. A little bit further along with the vaccines, a little bit further along with reopening in various jurisdictions, and probably a good time to have a quick conversation on markets. Not lots has changed over the course of the week. We continue on sort of the major themes. We continue to be in a major structural bull market in equities that started in 2013. And these tend to go on 12 or 15 years with interruptions. We certainly had a significant interruption in the early part of 2020 and worked our way back and have been in this channel since then. NASDAQ has been in a structural bull market since 2016 and continues to march along, has been consolidating recently. So the big theme on one hand is equities as a whole. When we talk about rates, long-term interest rates, we think that we've gone through a structural low in interest rates. Going back over the last couple of years, the punctuation point would have been the plunge lower in yields in February and March of this past year. And that turn continues. And we've been talking about the fact that we believe we've gone through a bottoming in the commodity cycle, which has been in a bear market now for the past 11 years. So where do we stand on all of this? Well, the beat goes on. Since November, after the correction in September, October, the S&P 500 has been working its way higher, largely in this channel. We dipped briefly below the channel about a week ago and back up into the channel. We'll talk a little bit about that, but a lot of the weakness in the very large-sized technology companies that drag the index lower. You can see that when you look at the NASDAQ chart. It certainly has been a little bit weaker and came down to the 50-day moving average, held there and has rallied off there over the last 3 days. A very good day on Monday, good reversal, and Tuesday. And we consolidated a little bit today. I think the most important chart for the US equities right now is looking at the equally weighted S&P 500. And the equally weighted S&P 500 is trading right at the top of this channel. What does that mean? It means that very different than the last couple of years where the largest 6 or 7 companies dominated the return in the index because of their very large size. In this case, the average stock is behaving much better than the very large stocks. And that's an important distinction because it means that it's a broader market. There are more companies participating in the rally. It is not a market dominated by those big 6 or 7 names like Apple and Amazon and Netflix and Google and so on. So this is what we like to see. We like to see equities broaden the rally, have more companies participate, and we like to see the broad indices work their way higher. Now, when we talk about the themes that have been leading this market, some clear themes, but more important, coming out of very long periods of underperformance. So the sectors that are leading this market are sectors that are generally underowned. So while the index might be at highs, the component parts are moving separately. So financials, after underperforming since 2008, recently made an exit from a structural bear market, beginning a new structural bull market. And this is the very beginning. This is a group that in Canada we own broadly because Canadian banks didn't go through the same kind of pain as in 2008-9. But in the US, the regional banks, the money center banks have largely underperformed. But in this environment where rates have started to work their way higher and we're looking forward to a reopening and all of the stimulus is being brought to bear, this is a sector that's beginning to lead. And it's really important because it's a sector that has reasonably good dividends, and of course, lots of opportunity for them to grow them should the Fed continue to allow them to grow their dividends, and their capital bases are very well shorn up. Industrials is another major cyclical theme, a group that is, again, under-owned, that is highly tied to the business cycle, is a group that should do very well as reinvestment picks up, as the economy picks up, a group that's under-owned. And then, of course, small cap securities or small companies that are more tightly tied to the US economy have had very good relative price performance versus the S&P. This rising line means that it's been outperforming the S&P 500 going back to October. And that continues. We made a new absolute high today in small cap securities and a new relative high versus the S&P. So we've been talking about the fact that we are in a bifurcated market, that there are certain groups that have been under-owned for a long time, that have taken over leadership in the market, and we want to identify that leadership early. Our job as an investment manager is to find leadership and focus our attention in those areas, find the best companies we can find to invest in to take advantage of these themes, and then to stay with them as long as they work. Use our stop losses to ratchet up in behind to protect gains along the way. And we'll talk a little bit about some of the groups that we've reduced our exposure to along the way, but these themes are continuing to lead. The other area of equities that have really started to take over are global equities. And this is the Taiwanese market. After going sideways 20 years, broke out a number of months ago and is working its way higher, again, outperforming the S&P. And we've talked a little bit about Japan. So other global developed markets joining the rally. That means the breadth is expanding, more groups participating, more geographic regions now outperforming. And these are new structural bull markets to join the structural bull market that exists already in US equities. So big changes afoot. Equities as a whole really taking leadership. Now, to make a point as to how early days this is, these are the flows into or out of equities over the last number of years. And you can see that institutional investors have steadily been taking money from the global equity asset class. Private investors have been very steady sellers of global equities. And I understand why. It's an asset class that's sort of underperformed. And even hedge funds were taking money from the global equity asset class. If we look at what's happening year to date, it's still just making a turn. Hedge funds just starting to tip higher, and private clients just starting to tip higher. So when these flows begin, they can go on for a long time. Now we've talked about bonds having rolled over in price or where yields have started to rise. We can now see that over the last year, 366 days, the long end of the bond market has fallen 23%. So as a bond investor, great to get your coupon, but if the price of your bonds are falling, not very appetizing. And again, we think this is the beginning of something. These are the flows into into bonds just over the last 2 years, about $1.3 trillion into the bond asset class, seeking safety, and just starting to see that moderate. Our base case is that we could see money come from the bond market and into global equities for the next many years, with interruptions. So I think we've been on these themes early. They look to continue and continue to march higher. So what does well in reflation? Companies that have an ability to grow their dividends. And we see again in the RDVY ETF, which is an ETF that holds companies with a history of growing their dividend, again, marching higher, especially since November, relative to the S&P, significantly outperforming again today, making new absolute highs in the price and new relative highs versus the S&P. So these themes all continue. So important new long-term themes established since November and ones that are likely to go on. What else? We talk about commodities going through a bottoming process, the commodities index, which bottomed back midway through 2020, 10-year bear market, which has reversed. Again, it's not going to go straight higher, but again, trying to find themes that are going through a significant long-term structural change, be invested, and have people come in behind us. So this has been led by agricultural products that came out of a bear market that started in 2008, only just ended midway through 2020. In global base metal mining, this is the mining ETF. And a great example of that would be Rio Tinto, which basically spent 10 years going nowhere, starting a new bull market. And even over the last number of months, energy. And this has been a group that we've been building exposure to. We came into this year with not a lot of exposure, and that has been growing. We keep in mind that we still have not been able to exit this bear market. We're at an important point, but all of the signaling across the commodities complex is favorable, and it is likely that this follows along too. So as you know, our process is all about trying to find new structural themes to invest in that are underowned, where there are tailwinds. We know that the Fed and governments around the world are stimulating the economy, both through fiscal stimulus and monetary stimulus. And that does not appear to be going to stop anytime soon. Our job is very basic. We need to use the tools that we have to find market leadership themes. And these themes clearly are early stage, but in gear, and we are invested. To always watch for change, to try to find new themes as they emerge, like this energy theme. And then, of course, if there is no leadership, or if we're seeing significant deterioration, be prepared to play some defense. Now, we've done this as a firm for a long period of time, and it's all about having sort of tactical portfolios that will participate. One of the themes we talked about recently was Bitcoin and the digital currencies, and we started to invest in digital currencies back in the late part of 2020. And of course, they've had a very good move since then. Actually, Bitcoin came very close to making a new all-time high today at $57,000. This is something, again, likely to continue on as US government continues to print currency. Investors looking for safe havens or places to put their savings that can't be diluted. So commodities are one area, equities are one area, digital currencies are one area. And we're always starting to start with a little bit and work our way into a new theme. So if I touch on it, through the 1990s, it was about growth stocks, consumer discretionary companies, healthcare, and technology. And that theme went on for a long time. As we came out of 2000, the income trust train began, and we started investing in income generating securities. And that theme went on for a very long time and did exceedingly well as the group was revalued. In 2009, we were fortunate to find the beginning of the fracking boom in energy. And so we had holdings in pipelines and service companies to try and take advantage of that. And so major structural themes have always been important to us. And I just want to go to sidetrack for a moment. About 4 years ago, Greg Guichon came to me and said, there is a new theme I want to focus on. It's an income-oriented investment. It's one that pays a very steady cash flow, but it's one that our investors are not used to. And it's investing in music copyrights. So our business has always been in public securities. And I said to Greg, I understand the concept. We spent some time talking about it. I said, I'm not sure our clients will. And it's not a public market security. We need to learn more about it, and we need to have the right partners. So as it happens, about 18 months later, he came back and said, I think I found some good partners. They were two industry veterans, one in New York and one in London, who, among other things, had managed the Rolling Stones and Elton John. One had run Sony Rock. And we decided to put together a tester fund. The idea was buy catalogs of copyrights, songwriters' copyrights, where we would be paid the royalties ongoing from anybody who used those copyrights. and we raised a small fund, about a $20 million fund. So that was about 2.5 years ago, and it fortunately worked out very, very well. So this week, we announced that we are starting a new fund. Now, the idea is we're looking for assets that pay our investors a steady stream of returns without a lot of risk, with something that is less correlated to the stock market. We have lots of exposure there. And importantly, if we're in a world where rates could rise over time, we're going to need a rising stream of dividends to pay our investors to offset rising interest rates. And this is where the music royalties come in. So I'm not going to spend a lot of time on this today. We are going to do a call next Thursday at 1 p.m. We'll send out invitations. But basically, the reason we want to own this is that streaming globally, paid streaming, companies like Spotify and Apple Music are growing quite rapidly. This is a chart that comes from a report written by Goldman Sachs talking about music streaming. You may have heard over the last number of months, people like Neil Young and Fleetwood Mac, Stevie Nicks, have sold major parts of their catalogs to financial investors. We were fortunate to find some excellent partners to partner with in this joint venture. And the idea is to build a fund that would invest in catalogs of copyrights and pay out all of the income to the investors. The asset class is interesting because when we look at catalogs, we get detailed data down to the day, per song, per streaming channel. So we're able to get a lot of data to do analysis on the catalogs and look at the rates of return that we think that we can find. The asset class is completely uncorrelated to the economy or to the stock market. And it looks as though streaming subscriptions will continue to grow. We've had some excellent press. There was an article in Forbes magazine recently talking about why Canadians have done so well in streaming. Since we made our announcement, there was an excellent article in Billboard magazine and Canadian Musician talking about the group that we partnered with on the fund. And without spending a lot of time on it, I think this is one of those structural themes that could be very attractive. Good cash flows attached, good growth to the dividend, and very stable returns. So this will be something that we'll spend more time talking about over the next little while. I won't spend lots of time on it today, but please look for an invitation to a webcast next week where we're going to bring our music partners to the table and talk through the idea sort of more in detail. But the idea is we're looking for something that is similar to what we get from our income product, but with different characteristics, and one that will work well in sort of a rising rate environment. Okay, so just to kind of get back to current markets, when we go through our top-down work right now and we look at our breadth work, we are seeing some changes. We have some very clear themes that are showing some good performance in the cyclical areas of the market, in the commodities, in dividend growth, and we've got a lot of focus in this area. Over the last little while, we have seen a little bit of weakness in technology. We continue to see some weakness in things that act like bonds, so utilities and consumer staples and REITs. So these are areas that we've been avoiding. If we look at our sector weights, they continue to change. So financials continue to become a more important part of our portfolio, and that's made up of banks. It's made up of some insurance companies. It's made up of some payments companies. There's a whole gamut of financial services companies that we've focused in. Energy, of course, has made a pretty significant move over the last number of weeks as energy prices have been working their way higher and we get closer to reopening the economy and demand is picking up. Technology continues to be a smaller piece than it has been in some time. And materials continues to grow and is relatively significantly overweight in our portfolios. So the weightings are moving around. We are very focused in these leadership groups. We are seeing a continuation of the strength and breadth in these groups. We are seeing a continued underperformance in the groups that are less tied to the economy, and we think are relatively overowned. We're going to keep watching for changes, but at this point, our work continues to point to pretty constructive markets. Globally, breadth is positive in Asia and in Europe. It's positive in the US in mid and small sized companies. In the NYSE, it is less favorable in the NASDAQ and less favorable in growth stocks. So it's quite a bifurcated market, as I said earlier. So we've been trimming bond proxies and growth securities, and we've been increasing our exposure to value and mid-sized companies, and the market continues to strengthen. So should this change, we'll get more defensive. We're going to keep it pretty short for today because I think we have some questions. But Pamela, if there are questions at this point, maybe we could jump into them.
Thanks so much, Dave. We sure do. Dave, this question is coming from one of our key investors, Paul in Toronto. He wants to know if there are any sectors and or stocks that Barometer had invested in over the course of the last few weeks that have not performed and which produced learnings for you and our investment team.
Well, look, technology has been leadership over the last year since the bottom in February. We were pretty careful not to focus in the what we call unprofitable tech, or really the blue sky type companies. We were focused more in companies with good earnings and revenue, but that really hasn't helped all that much. So, where we have had some pullbacks are in technology. So for instance, if we just take a look at it, this is Apple. Apple topped at 144 in January. It's trading at 119 today. We made our exit as the stock was breaking down. Companies like Amazon have had a tougher go. Amazon, frankly, is down since September. So these are groups that we've had to slowly sort of rotate away from. We've reduced our exposure to semiconductors, not because it's not a great and important sector, but from a timeliness perspective, a little bit less attractive. We've certainly we've been stopped out of some technology positions, but as you know, we've been talking about rotating from growth more to value. And, there are some great sectors that are really underowned by the market that look really attractive. So I would say that's probably the biggest change that we've seen in the last few weeks. The first area of weakness was the areas tied to the bond market, like utilities and phone companies and REITs. And as bond yields moved higher, it's made it more difficult for high multiple growth stocks. And so we'll see whether they can find their footing. It's very possible they're just going through a correction and they'll regain their footing and we'll wind up rebuilding some weight there. But it's also possible that it could be a group that underperforms for a period of time because they are so broadly owned. And it looks as though we're seeing professional money managers rotate their holdings from these areas they were hiding in, at the height of COVID, because they were the only area of growth, into sectors that will reopen and will regain their footing from an earnings perspective.
Thanks so much, Dave. Another David, this one happens to be located in Victoria, BC. He has a question about cybersecurity. Curious what, if any, we are positioned in that space and thoughts on that sector going forward.
Look, cybersecurity has been a great place to be, and we had pretty good holdings through the course of last year. This is CIBR, which is a cybersecurity ETF, which holds a basket of companies, in the cybersecurity space. So had a giant run from March of 2020 through sort of the middle of February. Now, the group has had a pretty good pullback, about a 10-12% pullback. There's another ETF, HACK. Again, these companies are high growth businesses that trade at high multiples. Higher interest rates don't help. I think that it's a theme that we'll probably have some focus in going forward. But as for now, we really have taken down our technology weight in the short run. And we'll see whether after coming down to the moving averages, they can regain their footing. but the relative price performance over the last couple of months has been significantly weaker than the rest of the market.
Thanks so much, Dave. Walter has a question here. He says he believes that one of your tenets is that stocks should do well during a period of rising interest rates. Can you explain the apparent contradiction in that everyday yields seem to be increasing as the markets seem to be selling off? What are your thoughts on that, Dave?
That's a great question. So if I put up the chart of the TLT, which is the long end of the US bond market, let's just take a little longer view of it. Let's look at 5 years. So let's see. So as rates are moving down here, there's one of two reasons. Sorry, as bond prices are moving lower, there's one of two reasons. One, because we think that there is increased credit risk. And that is not the case, because we can look at the measures of credit risk as to how much it costs to insure against the default of an issuer. And credit default swaps are very inexpensive right now. So that's not the issue. So the other reason that rates can move higher is because investors believe that the economy will have a higher growth rate going forward. And so it's possible that as time goes by, short-term rates could rise. Now, the Fed's been very clear about saying we're going to keep rates low for a long time. And that raises one more specter, which is that if inflation was to pick up, then it might force them to raise rates earlier. So when rates are moving slowly, fundamentally, the reason is that we think there is growth in the future. But the market doesn't always move on fundamentals. Sometimes it moves for mechanical reasons. So if we have certain types of investors who say, I'm always going to have a 60-40 mix, 60% equities, 40% fixed income. And if bonds move down a lot in price and stocks have moved up a lot in price on a quarterly basis or a monthly basis, they are actually forced to sell the asset that's done well and buy the asset that's done poorly to rebalance their portfolio to get it back into balance. So at the end of February and at the end of January, in both cases, because equities had outperformed bonds, there was a mechanical sell that forced some selling in stocks and some buying in bonds. So that is one mechanical reason. There's another mechanical reason because there are large funds that have a different strategy, and that is to say, if equities have a certain inherent volatility and they are balanced by bonds, because they often go in opposite directions, those investors might have a leveraged position in bonds against their equity weight. Now, if stocks and bonds start moving in the same direction, they wind up offside. And again, they have to become mechanical sellers of both. So when we saw this very quick sell-off over the last 2 weeks in the US bond market, that spooked some of those investors and forced them to draw in their horns on both sides of their portfolios, equities and bonds. So we think that this is not a problem because we think that this big sell-off in bonds over the last 2 weeks was partly driven by the fact that the US Treasury had a very large bond auction to do this week, which means a lot of new supply coming into the market, and that probably temporarily depressed bond prices. So we think longer term bond prices will continue to work their way lower, but for the right reasons, because growth in the real economy is likely to continue to pick up. We're just coming out of a pandemic and starting a new business cycle. On the other side, as the economy starts to pick up, earnings likely to grow. And we know that in the most recent quarter, most companies beat the estimates by a sizable margin. Our companies almost by 30% against the estimates. And that's a reason to own equities. So in the 1950s and 60s, when rates started to work their way higher, stocks went up 15% a year. But they certainly had little corrections along the way, and we will too. When the market moves quickly in a knee-jerk way, it often causes this rebalancing to take place. And those are kind of mechanical things that run their course fairly quickly.
Sorry, Dave, I had myself on mute. The next question actually comes from one of our other investors. John wants to understand how our pools have performed over the last couple of weeks. I guess over the last week, if you'd be able to, I don't know, at your fingertips, be able to pull up a summary.
So the income pools have been relatively sideways over that period, because, as I said, dividend growth has continued to be pretty good as a group. The equity portfolio and long short, that would have been the two portfolios that would have had the largest tech weights, even though they were less than market weight, they certainly pulled back with the pullback in tech. The global macro portfolio pulled back a little bit, but the different types of assets that we hold there have been beneficial. So our short position in US bonds helped offset. Our holdings in Bitcoin certainly helped offset. Our holdings in the commodities certainly helped offset. So that portfolio only off a couple of percent. When you look at it, NASDAQ was down about 11% over the past week. And so it did have an impact in the equity portfolios in long short. We think that is probably something that's relatively short-lived. And we think that the strength in things like financials, there's the bank index, close to a new high today, likely to continue to be quite strong.
Thanks so much, Dave. Well, that concludes our questions for today. And I'll leave you with the final word.
Great. Well, listen, we're going to continue to do these as there are more significant changes. Of course, we'll spend more time on these things. I hope that some folks will take some time and listen to the presentation on the Music Royalties Fund. I think it's something that's quite interesting and is becoming quite an accepted asset class. We were very early in investing in the income trusts after the year 2000, when the tech boom came to an end. And that wound up being a great number of years. We think that this is an asset class that is in the early stages of being revalued favorably, and one worth taking a look at. And we all need to have things that are not just purely public market securities, and things that might complement and help offset some volatility. So we'll keep you posted on that. So thanks everyone for tuning in, and we look forward to talking to you again next week. If you have some questions in between, please don't hesitate to give us a call. We'd love to jump on the line with you. And everybody stay safe, and we look forward to reopening.
Thanks so much, Dave.